Hello everyone, welcome back to the channel. Today I'll be showing you another video of how to use the Excel sheets that are available on the website. In particular, today we'll be looking at the put call parity, which I think it appears in level 1 and level 2 of the CFA exams, but nevertheless it's an important result that even level 3 candidates should be aware of. The put call parity is an important theory. I wouldn't call it a model, important theory or important result that can be used to validate a lot of the option pricing models to ensure if they are correct pricing models or not, and this is particularly important for level 2 candidates who are involved more into the optional pricing topic. So the sheet will be available under both level 1 and level 2 of the website. If you go to the website, you will have it under one of both tabs. So let's just assume we will click on level 1, and then you will scroll down, and then you will find it somewhere in the middle. And the file that's there on the website will help you to solve problems related to the parity. And there are two sheets in the file when you download it. And the first sheet will show you what is the arbitrage that could result if the put call parity doesn't hold. So if there is any mispricing that occurs in the put call parity, how could you take an advantage of that, and how could you arbitrage the situation? The second sheet on the file will show you how to calculate the prices of synthetic positions, which is basically just simply a rearrangement of the put call parity. So if you go back and if you check on the website, you'll find the put call parity reading, and in that reading you will find this basic result, which says that the price of a call option plus the bond or the risk-free instrument should equal the price of a put option plus the price of the underlying. And to understand why this is the case, you need to look into the reading that's on the website, or it's also posted below the video, and it will show you exactly why the two profiles, basically the two payoffs of both profiles, the right side of the equation and the left side of the equation, is equivalent. If we rearrange, one part of the one use of the put call parity is to help you identify mispricing. The other use of it is to help you in pricing options to begin with. So if you have the price of a put option and the underlying asset, and you know the strike price already, so using all these elements, you can easily find the right or the actual price of the call option, the price that will not have any mispricing in the market. If we rearrange all these formulas, we can find the price of whatever value we're looking for. So if we are rearranging it in the way that I just described, we will be finding the price of the synthetic call. And if we rearrange it in another way to find the price of a put option, we will be finding the synthetic put or synthetic bond or synthetic underlying. Depends on the requirement in the question. So over here, let's look at it as an example for which we will be using the Excel sheet, and we will start with the arbitrage check. So we'll check on the first sheet to begin with. And over here it says if the price of 6-month call and put options written on a stock with a strike price of 100 are 7.5 and 4.25 respectively, and the discount rate is 10%, determine if there is any arbitrage if the stock is currently trading at 99, and how can we take advantage of this arbitrage. So let's move on to the Excel sheet and let's enter the data that we have. So we have a call price of 7.5, and we have the minute that you entered a call price of 7.5, by default the file is assuming a 0 value for all the other inputs. So this is why you are seeing that the left hand side is overpriced and the protective put, which is the put plus the underlying, is underpriced over here. And this is why it's telling you how can you take advantage of this arbitrage, is basically by selling the call, selling the bond, buying the put, and buying the stock. And it shows you what happens at maturity and how much you make a net profit right now. But this is obviously right now because we don't have all the information yet. So if we enter 4.25 for the put, we enter a strike price of 100, we enter the stock price of 99. The discount rate is already formatted to be included as a percentage, so all what you'll have to do is to enter 10 over here. And then finally we have the 6 month, which is represented as of a year as 0.5. This whole thing being said, now we have actually a misbalance in the equation. We have the left hand side, which is the fiduciary call, which is the call plus the bond, to be underpriced compared to the protective put. And this is why the best action would be to buy the call, buy the bond, sell the put, and sell the stock. And if you are interested in knowing what happens at maturity, then this explains what happens depending on how much the stock price ends up at maturity. The reading on the website, over here, if you can see it, the reading on the website, I'll just direct it to it, uses the same exact example. So I've just copied it from there, and it will show you the same table that you are getting from the Excel sheet. So now you can, if you think this material is a little bit tricky, you can go on and rearrange the numbers and just create your own numbers and solve it, and then double check, and it will tell you exactly how the process is done and if you get the right answer or not. So that's it for the arbitrage check, and right now we'll move on to the second part of the question. So assuming the same data as in the previous question, find the price of each of the following: synthetic call, synthetic put, synthetic underlying, and synthetic bond. Basically here we will just gonna ignore the value of the item that we're looking for. So in the synthetic call we will enter the same, all the information that we have, except for the price of the call. All what we're trying to find here is what is the right price of a call option if all the other data is given. So we'll go back and we'll go to the synthetic calculations, and you will see over here there is a question mark, which assumes that you cannot, and you can't even enter anything over here. So if you enter a 4.25, 100 over here, 99, 10, and 0.5, it's going to tell you that the right value of the call option should be 7.9, as opposed to the 7.5 that we actually just we had in the question. And this is why there was a net profit difference of 0.4. I think it should be clear right now where did it come from. So the right call value should be 7.9. If we do the same thing with the put option right now, if we assume 7.5 and then strike price of 100, 99, 10, and 0.5, we end up with a value of synthetic put of 3.85, which is again different of 0.4 from the 4.25 that we originally had. We do the same here, over here, 7.5, 4.25, 10%, and then we get a value for the synthetic bond to be 6.75. And if we do it to find the synthetic stock price, so we assume 7.5, 4.25, and then we assume 100, 10%, 0.5, and that's it. The value of the synthetic stock would be 98.6. So that's pretty much it, I guess, about the example and the whole put call parity. If you have any questions, please feel free to email me, or make sure to subscribe to our channel and to follow us on the website to get notified about each and every new post. Make sure to follow us on our social networks, on our Instagram, Twitter, and Facebook, in order to participate in the daily CFA trivia. Thank you for listening, and goodbye.